This is Friday, so that means it's time for Bloomberg Opinion's Risk and Returns. I'm Lisa Abramowicz, along with John Authers, for our weekly chat. John, the story of the day, the story of the week has to be jobs, even though perhaps it didn't really have a clear direction for markets. The jobs numbers came in better than expected, 850,000. It was the biggest gain in 10 months. And what does this mean for markets? What does this mean for the Fed? What's your take?
Well, first of all, my basic take, following your body language, is much the same. It's very difficult. It's very, very difficult to tell because overall these numbers are largely in line with some sort of a median point between what bears and bulls, however you want to describe it, were expecting, and there is no number in this release, as far as I can see, that is sharply deviant or sharply scary, but there are enough numbers to support any of the different narratives that people might have had coming into this if you look more carefully. My own cautious take, and to be clear, this isn't what markets have taken from this, is that the argument for a slightly stronger recovery than we were expecting on balance, coupled with somewhat less transitory, stronger inflation than people were expecting on balance a week ago, I think that case has strengthened a bit over the last few days, but it has to be tempered by the fact that I have been proposing the thought that growth and inflation might be a bit stronger than people have been expecting. So,
hold on a second. I want to understand your point. That you think that basically inflation might come in less than people expect, but growth could come in more than people expect. You think that both growth and inflation could come in more, but this data didn't necessarily highlight that. In fact, there was evidence that things were returning back to the way that they were in the past, with the areas like leisure and hospitality having the biggest gains. But everywhere else, it's sort of, not status quo, but you're not seeing the same type of momentum.
You're not seeing the same kind of momentum. What makes me worry about the inflation part is that you are seeing quite a lot of people voluntarily leaving their jobs, which is the kind of thing you do when you are pretty confident about not only finding another one, but finding another one that will pay you a bit more. If you look at average hourly earnings, there was this massive compositional effect just over a year ago that probably hasn't passed its way all the way through the Python yet. But as it stands at the moment, it's 3.6%. In June of 2019, the last unblemished year, it was 3.4%. So that it's edged. The average hourly earnings does appear to have edged up very slightly. I'm combining that with ISM's earlier this week, where the prices paid number was the highest since 1979.
Definitely catches your attention.
And the conference board's inflation expectations, where consumers always think inflation is going to be much higher than it in fact is. I think they were expecting inflation over the next year of 6-point-something%, but the point was it's much higher and still rising. So put all those things together, and I think there is more evidence of inflationary psychology there than I was convinced of a week ago.
Those are interesting arguments, especially in light of what we're seeing in the food space as well, albeit not part of the core measures that the Federal Reserve looks at, but the idea that food prices are going up so much with the drought in the west of the United States, among other issues. Taking a step back, I think, though, that there was, I want to dig into a couple things you said. First of all, about the number of people quitting their jobs, which means that they think they can get another job that's better, that pays more. I thought that really what the data over the past few weeks has highlighted is just how much of a mystery the job market frictions are. Is it really an issue of the enhanced unemployment benefits that are basically paying certain lower wage workers more to stay out of work than going back to work, pushing them to actually ask for higher wages? Is it the fact that, frankly, schools are not open in person in a lot of places? This might be personal. I have understood how difficult that is and how much that makes a challenge in terms of getting work done. And there's the issue of health concerns, which has a little bit of a waning issue now, just simply because of the accessibility of vaccines. However, there are a number of studies that have come out recently that really call into question how much the enhanced unemployment benefits are really keeping people out of the workforce. I mean, there was one San Francisco Fed study that showed only 1 in 7 people would not take a job because they were earning enough with the enhanced unemployment benefits. We're talking about $300 a month. So if it's not that, what proportion of this is more permanent, is a sort of scarring, is a skills mismatch? And that's what concerns me, and to me, could potentially hold some of the inflationary pressures lower.
Yeah, well, first of all, I agree with what you've just said. There is some effect from the benefits that you can just about discern some impact on willingness to seek a job. But I agree that the balance of the surveys I've been reading, which probably includes some of the same ones you've been reading, is it's more important to note that the effect isn't that strong than that it's there at all. And obviously my kids are slightly older than yours, but I also am prepared to project about the issue of school, and now we're into school vacation for a period. So maybe everything will change in September or October, as we probably all long-suffering parents tend to hope for that kind of thing. I don't. So I agree with all of those things. I am nervous that a skill mismatch could yet lead. I mean, it obviously puts some kind of a lid on growth. It means that the companies that are pent up, waiting to get growing, are discovering they can't hire the people they need to get going. So it's deflationary that way. But it does also lead to upward pressure on wages, upward pressure, presumably because they're not being so productive, upward pressure on prices anyway. Again, I'm a professional worrier, but you can see some signs there, or more signs than I think are reflected in the market, of inflation. I think there are more reasons to be worried about inflation now than when inflation break-evens and were 50 basis points or whatever it was higher than they are now, and when the yield curve was significantly steeper than it is now.
I actually buy that. And I think that it echoes something that Mohammed El-Arian wrote in a Financial Times column earlier this week, where he was saying that a Goldilocks kind of environment could only persist for so long before it creates other effects, one of them being potentially higher inflation than people are currently pricing in. And I would agree with you that certainly if you look at the sort of direction of pressure in yields, in 10-year Treasury yields, it is lower. In general, people want to send those yields lower, even if you get a pretty good report, one that's better than expected, showing some real wage pressure. The idea here is, you can't stay in Goldilocks forever. So something has to shift. Either we have to have a less robust economy than people are expecting, less robust growth, or it's more robust and it sort of throws things off kilter. It really upends some of the Fed's basic thesis. So to that end, I mean, I'm trying to understand, and I'd love to hear you try to make sense of, because I'm not doing a very good job of it, of the yield curve response to these reports. The idea that, a sign of the Fed tapering earlier set the yield curve flatter, which means they expect the Fed to hike rates, that to slow growth, and then, later on, us to go back to that low growth environment, versus the steepening yield curve that a lot of people would expect if the Fed stops buying so many treasuries each month. I mean, honestly, I don't understand how these dynamics kind of play against each other.
In real time, from day to day, similarly, I mean, we all know that there are a lot of strong institutional pressures to buy bonds, which would explain why the entire curve would be lower, if you get what I mean. Like there's a downward pressure on yields across the curve. It is very strange. It's also quite concerning at another level, because one of the underreported good pieces of news this year is that the combination of sharply higher rates from a very low level plus a strong stock market was that pension deficits have almost disappeared in the last few months. And now they're coming back again because for some reason people are continuing to think it's worth lending money to Uncle Sam. And I suppose, incidentally, conceivably that's another issue which we might want to discuss, which is it doesn't have the hard edges, it doesn't have the hard data to it. But whether it's about fiscal policy, whether there is a concern about fiscal policy, and now that the Biden honeymoon is over, the notion that it's a lot less clear exactly what's going to happen in terms of Uncle Sam spending money in the next year or so. Maybe that is more of a a reason for bond yields to be subsiding a little.
Yeah, and perhaps bond vigilantes are just dead. We were speaking with Ed Yardeni of Yardeni Research earlier, who coined the term bond vigilantes earlier in the week. And I didn't coin the term then. He spoke with us early in the week. And he basically can't really find them right now. Before we get too off the reservation, last week I was remiss. I didn't turn to some of the other stories that we've been seeing in the market that we thought were interesting. So risk, return, go. You go first.
Okay, I've just alluded to it very briefly. I think the risk that is being understated is that the Biden attempt at growth really subsides. If you look at the first half, one of the things that took me aback, strip out the fangs, US stocks have still absolutely walloped the rest of the world, even though they had a much better year than the rest of the world last year. I think ultimately that's because of the positive surprise of the blue wave, Georgia, Biden's initial success in getting a lot of money through Congress. I think there's quite a big risk that is not going to happen now, that there will be a growth disappointment at the level of fiscal policy that isn't being discussed widely enough.
That's fascinating, actually, especially considering the fact that people still think that fiscal stimulus will compensate a bit. And frankly, that could send Treasury yields even lower, no?
Yes, that would be a good reason for Treasury yields to go lower. I guess counteracting that, there's also politics in Europe, but let's not open that Pandora's box this week. We've got months before the German elections, but the whole issue of whether you're going to get pan-European borrowing and a new risk-free asset in town to rival the US. I'm a little tired over all the years I've spent covering these things about big plans for wonderful new reforms in the European Union. So I don't want to put too much weight on it, but there's that there as well.
I hear that. The other issue, okay, as far as risk goes, one thing that I think didn't quite get enough attention because it was overwhelmed by the jobs report was the OPEC Plus meeting. I thought it was really interesting that they couldn't come to a resolution to change the output caps, to change the output targets going forward. If they don't do that, they are not going to materially, I'm talking about the OPEC Plus nations, they're not going to produce more oil to meet the higher demand as people fly again and as people drive around. There wasn't that big of a long-term effect in oil prices. They went up, but then they came back down. They're still around the highest since 2018. But what could that spike look like if there continues to be dissent between the United Arab Emirates and Saudi Arabia and Russia? How do you navigate that? How much could a lag send the cost of oil much higher? And this could be, frankly, disinflationary. I mean, it could be inflationary in the short term, but longer term, it slows people's willingness to engage in certain activities. I mean, typically that's one of the things that can trigger a bit of a sell-off. So I'm curious to see how that plays out, or if there could be some sort of short-term spike, especially given the calls for $100 an oil a barrel from Bank of America.
Yeah, very briefly, I'm inclined. It's certainly accurate that rising oil prices can be both deflationary and inflationary. Deflationary because they create a cost for people, which means they spend less on other stuff. As Western economies are less oil intense than they are, I'm inclined to think that this would be more on net and inflationary.
Interesting.
Than it has been in the past. It's not as stagflationary an impulse as it. Well, obviously, it was a massive stagflationary impulse in the 70s.
Yeah.
It is perfectly reasonable to think that it wouldn't be as stagflationary as it was then, because oil is less important. We're less oil intense.
That's a really good point. Okay, just because we've got 1 minute left.
Okay.
On the return side, what'd you have?
On the return side, I think actually keep investing in the recovery trade, industrials, maybe even materials. People aren't really taking notice of the fact that there is still a recovery going on, and that there's still a long way for the fangs and the pandemic trade from last year to unwind.
And I'm going to kind of cop out, and in the sense that Gina Martin Adams, I'm going to ride her coattails of Bloomberg Intelligence. And I thought that, everyone who comes on Bloomberg Surveillance talks about focusing on companies that have pricing power, that can pass along higher costs to their consumers. And I asked Gina Martin Adams this morning, do you think that trade is played itself out, or do you think it's just beginning? And she said, it's absolutely just beginning. This is going to be a theme for the next few years. And I think that's pretty fascinating.
Might mean Berkshire Hathaway. The nice way to put that is look for companies with wide economic moats, like Warren buys. So yeah.
So that's what I've got. Anyway, that's it for us. It's 11:45. Have a wonderful weekend, John, and have a wonderful 4th of July.
You too.
Okay, take care.